Well, folks, it's time to kick it old school. So you can feel cool. Yeah.
Hey, what's up everybody? Welcome to Ala's World of Finance. I hope you're all having a fantastic day. Today we're going to be talking about bonds, and this video is long overdue. I've received several comments asking me to explain what bonds are and how they work, and so that's what we're going to do today. It's going to be a very introductory video, so if you don't know anything about bonds, you're definitely in the right place. I'm going to explain everything in a simple and easy to understand way, and I will also give an example so that it's easy for you to follow along. In the future, I'll make a more advanced video on bonds, and I will also make a video showing you how to invest in bonds step by step and what to look for in them. So make sure you're subscribed to see those. But for now, let's talk about the basics of bonds and let's go ahead and get started. So what are bonds? Well, they're sort of like loans, but it's a little tricky because, usually you and me, when we need a loan, when we need money, we go out to a bank and we take out a loan and we have to pay back the bank that principal amount of money that we borrowed plus interest. Well, with bonds, you and me as the investor, we're actually the ones giving out the money. So we're actually the ones sort of giving out the loans. And we give this money to companies or governments, right? There's definitely government bonds. And you may be asking, why does a big company or a government need our money? Well, a company may be looking to expand, and so it may have a lot of costs, things like that, and so it needs additional funds. A government has income from taxes or other sources, but they may spend all their money. They have to keep up with costs, so they may need additional funds as well. So there's several reasons why. And so what will happen is a company or a government will sell us one of these bonds, and it's basically like a little piece of paper that says I owe you. So let's run through an example. Let's say that we purchased a government bond for $100. Okay, so then what happens is we give $100 to the government, and the government gives us a little piece of paper that says I owe you $100, and it's essentially the bond. Okay, now we can also choose a certain time range for that bond. So let's say that we choose 5 years. Okay, so let's say that this is a 5-year bond that costs $100. Well, in 5 years, this bond will reach its maturity date, and the government will have to pay us back $100. Okay, after those 5 years. And so now you may be asking, it sounds like we broke even, so how exactly do we make profit off of that? Well, loans usually have interest rates, right? So what happens is, depending on what the interest rate is, and sometimes there can be other factors as well, but to keep it simple, let's say that the interest rates in general are at 5%. So what will happen is the government will issue us a coupon. Okay, in the bond world, they call this coupons. In the stock world, you can sort of think of it as dividends. But dividends are not guaranteed. Coupons are guaranteed. Okay, so this is a fixed amount of money, and so because interest rates are at 5%, the government will take 5% of $100. That's $5, and they will issue us a coupon of $5. And let's say that they agree to do this once a year for those 5 years. Okay, so every year for 5 years, we get a $5 coupon. Okay, we get $5, and that's fixed. That amount will never change. Okay, we get $5 for that bond. We get a $5 coupon. Now the percentage of that coupon, right? It's 5%. That's called the yield, and that can change, and I'll explain that in a second. But the actual coupon amount, the $5, does not change. That's a fixed amount. Okay, now you may be asking, everybody usually says that investing in bonds is a safer strategy. You should diversify by investing in bonds. Why do they say that? Well, there's a few reasons, but usually if you're buying a bond from a big company or a government, it's very unlikely that that company or the government is going to go bankrupt, and so very low chance of you losing all your money, right? And sometimes that can affect the bond price if a company is more reliable and has better credit, things like that. But anyway, another reason is because bond prices don't usually fluctuate as much as stock prices do. In the stock world, share prices can go way up and way down all the time, and there can be volatility. But in the bond world, that doesn't usually happen. It doesn't go up and down as much as it does in the stock world. Okay, so what does affect bond prices, and what makes bond prices go up and down? Well, there can be a couple of reasons, but I think certainly the biggest reason is because of interest rates. And so let's run through an example. So we purchased our $100 5-year bond with a $5 coupon, which is 5% yield. Okay, let's say that interest rates go up to 10%. So now all new bonds are going to have a 10% yield, right? Because the government governments or companies are going to issue out, $10 coupons based on that 10% interest rate. So now everybody is getting 10% yield while we're stuck at 5% yield. So if you're a new investor, which one are you going to purchase? The 10% yield or the 5% yield? You're obviously going to get the 10% yield, right? You want to make more money. Okay, so that brings down the value of our bond. And the reason why is because we need to get our $5 coupon to equal a higher percentage, because we need to get it closer to the 10%, because all these new bonds are at 10%, ours is at 5%, we need to get it closer to 10%. So one way that we can do that is by bringing down the price of the bond. Okay, not the principal amount. The principal amount stays the same. The principal amount of the bond is $100, and at maturity, whoever owns that bond gets back $100. But the price of the bond can change. And so what happens is we need to bring down the price of the bond. So in this example, let's say that we bring down the price of the bond, or the market does, right? The market brings down the price of the bond to $50, okay? So if you bring it down from $100 to $50, all of a sudden that $5 coupon is now worth 10% yield, because $5 of $50 is 10%. So now you got that 5% yield to equal 10% yield, and now it's similar to the other bonds out there, right? But we had to bring down the price of the bond. Okay, now as an investor of that bond, you have a couple choices. You can sell the bond, but you obviously lose some money, right? Because you purchased it at $100. The principal amount stays the same no matter what, but when you first purchase a bond, you purchase it at that principal amount. So you purchased it at $100. Now it's worth $50. So if you sell it, you just lost $50. But you can jump into a new bond that has 10% yield. Okay, so that's one option. Another option is you could just hold the bond. Now, if you hold the bond, everything is going to stay the same for you, so you're going to keep making 5% yield. Okay, but if you're okay with that, the price of the bond will actually level out once it gets closer to maturity, because when it gets to maturity, the coupons won't matter anymore, because at maturity the bond ends, right? It runs out of time. So at maturity, the government still has to pay back $100 no matter what, right? The principal amount never changed. Only the price of the bond changed. So once you're at maturity, you still get $100 back. Whoever owns the bond will still get $100 back on that bond at maturity. So it's just a couple of different options you could do. You could either sell it and get better yield percentages, or you could keep it, have a lower yield percentage than everybody else, but you'll get back all your money plus whatever you were making additional. So there's just a couple different options. So we can cover that more in a more advanced video. But anyway, those are the basics of bonds. I hope that I didn't confuse you guys. If you have any questions, please feel free to leave a comment below. This was all just examples, so please don't get too technical with the examples I was giving. It's just kind of basics, and it's meant to not really overwhelm you too much. Okay, I hope that you enjoyed the video. Thank you so much for watching. I've also been receiving requests to do cryptocurrency videos, so maybe I'll do some of those in the future as well. Anyway, thank you for watching. I hope that you'll have a wonderful, beautiful day, and that you take care.